Okay, I'm going to talk a little bit about how to allocate this hedge as far as money management, and I'm going to get into some details here. Looking at this half of the spreadsheet here, this is the going along the S&P 500 and allocating $7,500. This is allocating $7,500 to the Dom Hedge, these numbers. Now, what I've done is I've broken down the market into 15 time frames. Now, this first time frame started here at 12/31/07 to 9/2/08 and took 8 months. And it was a grind down market. And what you can see is how the S&P did. It was down 13% during that time frame. And the hedge did 3.43%. So obviously the hedge didn't cover the loss, but that's a grind down. And then there was a grind down, again, a 4-month grind down after that, from 9/2/08 to 12/31/08, where the market was down 30% and the hedge did 10.28%. Then for another 3 months, there was another grind down where the market was down 10% and the hedge just broke even. So you can see that during the grind down markets, this hedge is not going to particularly cover. It's going to help, but it's not going to cover your losses per se. Then we had a bull market for another year and a month in 2010, and the market went up 46%. The hedge went up 1.7%. So the hedge didn't lose money during the bull market. It didn't cost anything to hold this hedge. Then there was another grind down in 2010. It lasted 3 weeks, where the market went down about 10%. The grind down, the hedge actually went up about 5.5%. So it did help you a little bit. And then we had a bull market for 5 years and 2 months, from 2010 to 2015, where the market was up 96%. The hedge just broke even, basically, down 1% during that whole time frame. So during that 5-year bull market, the hedge was protecting the portfolio, the long portfolio, against the crash, and it didn't really cost anything during that whole 5-year period. Now we're going to get into what I call the modern crashes. The modern crashes occurred in August 2015, February of 2018, and March of 2020. These are what I call modern crashes because they actually activated the hedge, and they activated certain volatility hedges. And based on what's happened in the past, it looks like these are the types of crashes that we're going to have in the future. And this is the kind of modern crash that we've had since 2015. So this was a 2-week crash, and the market was down 10%. The hedge made around 18%. Then we came into a bull market for 3 years and 5 months, where the market was up 50%. And the hedge held its own, it didn't cost anything, and it was up 3.5%. Then we had that crash in February 2018. It was a 9-day crash where the market was down 7.2%, and the hedge was up 18%. So that would have covered your, depending on how you allocate your capital, it could have covered your losses. Then we had a bull for 8 months. We had a bull run, market up around 11.5, hedge up 1.5 or 1.1. So the hedge didn't cost anything. Then we had this significant grind down, which is the last 3 months of 2018, where the market was down around 14.2, and the hedge actually cost 8%. That was the only time the hedge actually cost money, and that was during that significant grind down where the market was down over that 3-month period significantly. Then we had a bull run for about a year and 2 months. The market went up 34.5%. The hedge held its own, didn't cost anything to hold it. Then we had another modern crash, which was in March of 2020, and it lasted for about a month. The market was down in this time frame between 220 and 323. It was down 33.67%, and the hedge was up about 36%. So the hedge held its own there and actually helped the portfolio. And then we've had a bull market since that crash for about a year, and the market went up about 80%, so quite a bit. And the hedge actually did 12% over this time period. This is kind of a period of volatility crush, and the hedge does well in that environment also, but that's not really the purpose of this trade structure here. Now, what I really look at the way I look at this hedge is it's really just a modern crash hedge. So I took the 3 modern crashes that occurred, and during that time, during those 3 occasions, the market was down 50%, but on average it went down around 17% on average during the crash. And when I look at the hedge, it had about a 72% return, but divided by 3 to get an average of about a 24% return during these types of crashes. So this will help us kind of allocate our funds. So let's talk about the possible allocation of funds. So when you look at this, I had to give like a portfolio size just to kind of see what we would do. Now I want to make something very clear right here. Allocating a percentage of your portfolio towards this hedge means that you're going to use span margin. If you have portfolio margin, you don't have to allocate capital towards this hedge. It's cross margins. So if you're using SPX and you have portfolio margin, this does not apply. Portfolio margin is much better, but this is applying span margin only, okay? This is what these numbers are right here. So if you did a 10% 90 during an average modern crash, your hedge will pay off about $2,400. You'll lose about 15. So you'll end up down about 13% rather than the average 17%. If you take 25% of your capital and apply it towards the hedge and 75% towards a long portfolio, when there's a crash, you'll make around $6,000 on average and lose around $12,700 on average. You'll end up with $93,000. You'll go down about 6.7% using 25% on this hedge, which is better than losing 17%. And then if you take your portfolio and you do 50-50, 50% of the planned capital to the hedge, 50% to your long portfolio, you'll see that you actually come out ahead during a crash or during the average crash of 3%. So let's take a look at that. This is another 50-50 allocation. And this is just saying that if you started with $7,500, what would have happened to you if you were just long the S&P? And starting from the beginning of 2008, you can see you drew down here and then you've made your way up. And you ended up here by April of 2021. So your $7,500 turned into around $20,500. If you just did the hedge, nothing else, your $7,500, you wouldn't have the drawdowns. It's a little smoother equity curve, but you would end up with around $19,000. So the hedge itself, if you look at it and you just break it away and use it by itself, it actually makes money. So you can see during these time frames that your $7,500 ended up in $20,500. Or if you just put your money 100%, say, allocated to the hedge, say you only had $7,500, you allocated all of it just to this hedge, you'd have to have a lot of patience. Trust me, because you'd go for 5 years without making a return, but you would actually end up ahead. You'd end up with $19,000. So the hedge itself doesn't lose money. You just have it there. And the main point I'm making here is when you have this hedge on and you're using span margin, you're going to have to allocate capital towards that hedge. Like, are you going to allocate 10%, 25%, 50%? These are the kind of things you can expect. If I was to allocate 10%, 25%, 50% of the capital towards the hedge, these are the kind of things numbers that I can expect here. Here's another chart I put together, and this is the S&P 500 versus the Dom Hedge, but also I've combined the two. So if you look at the S&P 500, you can see a lot of volatility where you were down pretty significantly. All 3 of them starting with $7,500 because that's the minimum tranche size. And you can see what happens if you held the S&P. Look at those drawdowns that you'd had. And you see a lot of volatility. Look at all the volatility. And you do end up higher. If you use just the Domm Hedge by itself, pretty smooth, but it really is difficult to stay in something like this because you're just not making any money for long periods of time. But if you did the 50-50 allocation, if you allocated $3,500 to the S&P 500 and $3,500 to the Dom Hedge, you can see the blue line where you did come down a little bit, but the drawdowns are relatively insignificant. But look at how smooth that equity curve is. You don't see a lot of heavy drawdowns. So if you combine the two, if you like a smoother equity curve, one where you don't see a lot of volatility, that might be something to look at in the future, because you know when the market crashes, you really probably don't like it when your portfolio is down 50%, and you might prefer something with a lot smoother equity curve. When there's a crash, it doesn't really affect you as much, but when the market goes higher, you can participate, or when it crashes, you can participate. Now let's talk about portfolio margin. This is a totally different ball game. You don't have to allocate. With portfolio margin, I don't have to allocate 10% or 25% or 50% of my portfolio, because 85% of my portfolio, if I'm long stocks, can be used for options without taking any money away from that. So let's say I started with a $100,000 portfolio. I don't have to use 10% or 10,000 or 25,000 or $50,000 and allocate that money towards a hedge. I can take $85,000 and allocate it towards a hedge and still keep my $100,000 long portfolio at the same time. Okay. So let's say that I did this. Let's say I used 80% in cross margin. So I have a $100,000 portfolio. It's long stocks. Let's just say it's long the S&P 500. And I also use $80,000 for the hedge, or to trade options. It sounds like I'm using $180,000 total, right? But I'm not. I'm cross margining. Okay, so using portfolio margin is a lot more effective when using this. So if you were just long, you start with $100,000 at the end of 2007, and you were just long the S&P 500, you can see by April 2021, you'd have $273,000, which is really good, right? 100,000 to 273. But if you combined it, which again doesn't cost you anything if you have portfolio margin, if you combined it with 80% of it, $80,000 allocated towards the hedge, you still have a $100,000 portfolio with long stocks or along the S&P 500. And you have the hedge on at the same time. You can see that by April, you're going to be up to $396,000. So you can see how effective it is to add this hedge to a long portfolio. You can, if it's just long portfolio, $273,000, add the hedge, which doesn't cost anything. It doesn't take away any of your capital or anything. You just add this hedge to it, and now you got $396,000. So much higher return, much more efficient when you're using portfolio margin